Soft U.S. inflation data is colliding with hardening energy and geopolitical risks, forcing a rethink of how portfolios take risk. This is vTalkInsight, Allocator's Lens Daily for July 15th, 2026. We will connect disinflation headlines, higher for longer fears, and an AI-driven earnings cycle across equities, rates, credit, currencies, and commodities. In equities, softer U.S. inflation has extended the risk-on tone, but also highlighted how mature this rally looks. A negative headline CPI print and flat core reading pulled Treasury yields lower and helped the S&P 500 Nasdaq move higher. Yet major indices again failed to break to new highs, suggesting a more selective phase for risk. Banks remain at the center of this phase. Global bank stocks carry strong momentum, and early results show solid loan growth, healthy credit quality, and powerful trading and deal-making revenues, with equity divisions at leading U.S. houses delivering near-record takings. Yet share price reactions have been muted as investors worry about rising operating costs, future deposit pricing, and how long this backdrop can last. Technology shows an even sharper divide. Hardware, memory, and data center names tied to AI infrastructure are rebounding and helping the Nasdaq outperform, while software is under pressure. IBM's steep post-earnings drop illustrates how quickly budgets are shifting toward compute and storage, and how unforgiving the tape is when results disappoint lofty expectations. Higher oil prices are also reshaping leadership. Energy stocks, particularly in Europe, are outperforming as Brent trades in the mid to high 80s, while travel, leisure, and some luxury names lag on concern over fuel costs and demand. With earnings misses punished far more than beats rewarded, equity risk is increasingly stock and sector-specific, putting a premium on understanding how AI, banks, and energy-sensitive sectors interact. In rates, the headline is the U.S. disinflation surprise. Headline CPI turned slightly negative month-on-month, and core was flat, both below expectations, knocking more than 10 basis points off two-year Treasury yields and pulling the curve lower, which in turn helped ease financial conditions and support the latest equity bounce. At the same time, the medium-term backdrop still feels inflationary. Recent core weakness leans on volatile components, while food prices, a tight labor market, and strong nominal growth keep demand-led pressures alive, and inflation has sat above target for more than 5 years. With oil pushing European and UK yields higher, many see limited room for bonds to rally purely on softer data. Policy signals reinforce that tension. Fed officials have warned that another firm inflation print could revive talk of renewed tightening, even as the latest data cut near-term odds. In Europe, markets now price a more extended Bank of England hiking path, while Japan is the outlier, with strong demand at a 20-year JGB auction and potential tax incentives pushing local yields lower and highlighting growing policy divergence. Credit markets still send a calm signal. Public spreads are tight, with BB risk in the U.S. and Europe near cycle lows, and issuance is being comfortably absorbed, including from large technology and AI infrastructure borrowers increasingly tapping the investment-grade market. Major U.S. banks report charge-offs below expectations and little evidence of stress among mainstream retail customers, so concerns focus more on future profitability than solvency. Private credit sits more in the opportunity camp, but with greater dispersion. It is not seen as a systemic threat, yet managers expect a wide range of outcomes, particularly in Europe, where companies are turning to non-bank lenders to finance capital spending as public budgets stretch and supply chains are rewired. That keeps structure, covenants, and manager selection at the center of any credit-based allocation discussion. In foreign exchange, the dollar remains the anchor. Softer U.S. inflation has eased pressure for additional hikes, but relatively high U.S. yields, solid nominal growth, and persistent capital inflows still provide structural support, leaving the greenback broadly fairly valued and limiting the scope for a sharp move lower against other major currencies, including a largely range-bound euro-dollar rate. Against that backdrop, carry continues to dominate many discussions. Brazil's real is often highlighted for unusually high real yields despite some election-related uncertainty, and many relative views favor it over lower-yielding commodity currencies, such as the Australian dollar, where similar exposure comes with far less income pickup. Elsewhere, domestic policy signals are in focus. In Japan, proposals for tax-free treatment of government bonds and incentives to repatriate capital could, if enacted, gradually support the yen and complicate its role as a funding currency. Sterling has outperformed as political clarity reduces the fiscal risk premium, though further gains may hinge on credible policy follow-through and how the Bank of England responds to higher energy costs. In commodities, crude remains the key swing factor. Escalating U.S. and Iran tensions around the Strait of Hormuz, including renewed naval blockades, strikes near key ports, and new transit fees on tankers, have disrupted shipping and pushed Brent into the upper 80s, embedding a clear geopolitical risk premium that may not fade quickly even if rhetoric cools. Refined products deepen the macro impact. Diesel and gasoline supplies are constrained as global refining capacity lags demand. U.S. refineries run near 96% utilization, China withholds spare capacity, and Russia curbs diesel exports after refinery attacks, keeping pump prices elevated. That is driving sector rotation in equities and lifting inflation expectations and bond yields in Europe and the UK, even as the U.S. is seen as better placed to absorb the shock without recession. Logistics and power add a structural layer to the story. Container shipping companies are seeing stronger demand and higher freight rates as Middle East disruptions tighten effective capacity, while efforts to reroute oil exports away from Hormuz will take years, not months. In the U.S., grid auctions have struggled to secure future electricity supply just as AI-driven data center demand accelerates, raising the risk that wholesale power prices trend higher and feedback into corporate margins and inflation over time. Across assets, the picture is one of tension between softer U.S. inflation prints and a still inflationary, energy-driven regime. Equities remain in risk-on mode, led by banks and AI infrastructure, but the market is unforgiving of earnings misses, making stock and sector selection critical. Rates are caught between disinflation data and higher for longer fears, while tight credit spreads and a firm dollar suggest overall financial conditions are still accommodative. In commodities, a durable oil and power risk premium is now a central macro driver, feeding back into inflation, policy paths, and FX. For allocators, the key watch points are upcoming inflation releases, central bank messaging, the durability of bank and AI-related earnings, and how long energy and power constraints persist. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.